Welcome back to the Neuro Finance Masterclass, and welcome to day 64 of our 365 Days to Financial Freedom series. So today, we're stepping into a deeply strategic realm. We're moving way beyond simple charts and graphs to master the ultimate neuro-fitness tool. You know, when you're navigating the financial markets, you aren't just trading numbers on a screen. You're literally trading human psychology. You're trading against the collective emotions of millions of people. And if you want to stop being the prey and start acting like the predator, well, you need a way to track those emotions. This explainer is your strategic guide to doing exactly that. We're going to look at how to take the raw, chaotic emotion of the crowd and turn it into a weaponized metric that you can use to your absolute advantage. Let's get right into it.
It's kind of a fascinating question, isn't it? How do you mathematically measure the invisible? I mean, really think about it. We can measure revenue, right? We can measure profit margins. But how on earth do we measure exact, invisible investor terror? When a market crash is looming, the air is just thick with panic. But panic is an emotion. You can't just guess how scared the market is by reading headlines or, listening to the news. Wall Street refuses to just guess. The elite players, they don't operate on gut feelings. They demand hard data. They absolutely need a radar to show them exactly what the crowd is feeling in real time, long before the ultimate damage is done.
Okay, let's dive into this. You might already be familiar with some of the basic tools out there. We have the RSI, or Relative Strength Index, and that's a fantastic tool to measure momentum. It tells you if an asset is overbought or oversold. We've also talked about moving averages, which are absolutely essential for finding and confirming the broader trend. But while those tools tell you what the price is doing, today we're introducing the architect's ultimate contrarian radar, the VIX. Unlike RSI or moving averages, the VIX doesn't measure price direction at all. It measures terror. It measures the raw, unfiltered level of fear currently pulsing through the entire financial system.
So what exactly is it? Well, the VIX, or the Volatility Index, is famously known across the financial world as the Fear Index, or the Fear Thermometer, and I just love that analogy. It's this real-time number that calculates exactly how much explosive price movement professional options traders are expecting in the S&P 500. Think of it like this. It's the only thermometer in the world where a high temperature means the patient is panicking, not sick. And listen closely here, because this is crucial. You absolutely do not need to understand the complex, heavy calculus behind how this index is formulated. Seriously, leave the math to the quants. As a strategic investor, you just need to know how to read the thermometer. It takes all that complicated options data and distills it down into one single number that reveals exactly what the herd is feeling. Now here is the specific time horizon you need to lock into your mind. 30 days. The VIX isn't looking at what happened last year, even last week. It is a strictly forward-looking metric. It calculates the expected volatility in the S&P 500 over the next 30 days. This is the exact window that professional options traders are analyzing to price in future turbulence. I mean, they're putting hundreds of millions of dollars on the line based on what they think will happen in the next month. So by looking at the VIX, you're essentially looking right over the shoulders of the smartest money in the room, getting a real-time 30-day weather forecast for the stock market.
Let's look at the first extreme market condition you'll encounter on this radar. We call this the zone of complacency. Just imagine the stock market is booming. Day after day, the charts are green. Everyone is making money, right? From your neighbor to your barber. But during these periods, a really dangerous shift happens in the collective psyche. The crowd becomes infected with arrogance. They actually start to believe that the market will simply never crash again. They think they're financial geniuses, when in reality, they're just floating on a rising tide. This is a very quiet, very smooth, and honestly, a very ominous time in the market. It is the literal calm before the financial storm.
When the market enters this phase of absolute greed and arrogance, the VIX drops very low. We're looking at a reading of below 15. Now, a number under 15 is a massive warning sign for the trained eye. It signals that the market is heavily infected with extreme complacency. What it basically means is that insurance against a market crash is dirt cheap right now because absolutely no one thinks they need it. The herd is completely unbothered, totally confident, and entirely unprepared for any piece of bad news.
Now, what's really interesting about this slide is the stark contrast in how two totally different minds process that exact same low number. Look at the amateur. With a VIX below 15, the amateur looks at their portfolio, sees all that green, and feels perfectly safe. They might even take out leverage, thinking the good times will just roll on forever. But then, look at the architect, the strategic neurofit investor. The architect looks at that low VIX and feels deeply cautious, because the architect knows that a low VIX means the crowd is completely asleep at the wheel. They know that when nobody is prepared for a shock, even a small negative catalyst can trigger a devastating chain reaction.
And then, without warning, the storm hits.
Welcome to the zone of panic. This is the exact opposite of complacency. A sudden catalyst strikes out of nowhere. Maybe an official recession is unexpectedly announced, or a massive systemically important bank suddenly fails over the weekend. Suddenly, that illusion of safety completely shatters. The stock market starts crashing, and the crowd, who we just established was completely unprepared, right? Well, they begin panic selling everything they own just to stop the bleeding. The calm is over. The stampede has officially begun.
During this exact moment of violent market unwinding, the VIX doesn't just casually drift higher. It violently explodes upward. When the herd hits the sell button in unison, the fear thermometer spikes right past its average levels, crossing 30, surging past 40, or even hitting 50 and beyond. These numbers indicate pure, unadulterated terror. The market is violently repricing risk. Options traders are suddenly demanding a massive premium for downside protection because, well, the bottom is falling out. This right here is what a meltdown looks like mathematically.
And this brilliantly illustrates the ultimate psychological dichotomy between the herd and the true contrarian during a crisis. Imagine a VIX reading of 45. The amateur stares at their screen, watches their net worth plummet, and is completely paralyzed by terror. They sell their assets at the exact worst possible time, locking in permanent losses because the fear is just overwhelming. But the architect sees that VIX at 45 and smiles. And look, they aren't smiling because people are losing money. They're smiling because they recognize the mathematical signature of maximum opportunity. They know that peak fear equals peak financial discount.
This brings us to a legendary aphorism, a core rule pretty much etched into the stone of Wall Street. Read it with me. When the VIX is high, it's time to buy. When the VIX is low, it's time to go. It sounds so simple, but executing it requires absolute iron discipline. This is the ultimate rule for weaponizing crowd panic. When the VIX is low and complacency is sky high, it's time to take profits, raise cash, and step back. It's time to go. But when the VIX is screaming high and the world literally feels like it's ending, that is exactly when you step forward and buy.
So, the crucial point is understanding the hidden mechanics behind that massive spike in fear. If you recall our lesson from day 41, earlier in this journey, we talked about blood in the streets. Well now, on day 64, you have the math to prove it. An explosive VIX reading means we've reached that point of maximum blood. But here's the thing. It's not just retail investors panicking. An extreme VIX often means that massive institutional whales are stepping in and forcefully triggering mass liquidations. They're hunting stop losses, forcing weak hands to sell their assets at rock-bottom prices. The high VIX is basically the flare going up in the night sky, signaling that the wealth transfer from the impatient to the patient is actively taking place.
Let's move to and see how this builds your actual game plan. How do you execute this today? First, you need to open your charting software or your brokerage app and immediately add the ticker symbol VIX to your watch list. Keep it right next to your core holdings. Second, you must commit to acting as a pure contrarian. You cannot follow the crowd here. Your entire strategy relies on trading against them. Do not be afraid of that high number on the radar. And third, when that radar screams fear, you deploy your dry powder. That cash you patiently held on the sidelines while everyone else was being complacent, that is your ammunition. You strike when the herd is fleeing.
This tool fundamentally changes how you view a market crash. It takes you from being a victim of circumstance to an active participant in wealth creation. You now have the thermometer. You know what it means when the temperature drops into arrogant complacency, and you know exactly what to do when it spikes into blind panic. So I leave you with this final, critical question. The next time the stock market plummets, the headlines are terrifying, and the radar screams fear. Will you be the prey, or will you be the predator? The choice and the tools are now yours. Keep mastering your neurofitness, and I'll see you in the next masterclass.